Today, we will talk about the lower of cost or market (LCM) method, why it's used and application. The lower of cost or market method states that when valuing a company's inventory, it is recorded on the balance sheet at either the historical cost or the market value. Historical cost refers to the cost at which the inventory was purchased. The value of a good can shift over time. This holds significance, because if the price at which the inventory can be sold falls below the net realizable value, NRV, of the item, thus triggering a loss for the company, then the lower of cost or market method can be employed to record the loss. The lower of cost or market method lets companies record losses by writing down the value of the affected inventory items. This value may be reduced to market value, which is defined as the middle value when comparing the cost to replace the inventory, the difference between the net realizable value and the typical profit on the item, and the net realizable value of the item. The LCM method is part of generally accepted accounting principles, GAAP, used in the United States and in international commerce. Almost all assets enter the accounting system with a value equal to acquisition cost. GAAP prescribes many different methods for adjusting asset values in subsequent reporting periods. In 2017, the Financial Accounting Standards Board, FASB, issued an update to its code and standards that affect companies that use the average cost and last in, first out, LIFO, methods of inventory accounting. Companies that use these two methods of inventory accounting must now use the lower of cost or net realizable value method, which is more consistent with International Financial Reporting Standards, IFRS. The lower of cost or market rule traditionally applies to companies with products that become obsolete. The rule also applies to products that lose value due to a dwindled current market price, which is defined as the current cost of replacing outdated inventory, provided that the market price isn't larger or smaller than the net realizable value, which is essentially the projected selling price minus disposal fees. The LCM rule was recently changed, making things easier for businesses that do not use the retail method or the last-in, first-out method. Under the new guidelines, the measurement can be solely restricted to the lower of cost or net realizable value. The lower of cost or market method is used to value inventory by comparing the original cost and the current market price, and recording the cost of inventory by whichever is lower. This method is typically applicable to companies that hold inventories for extended periods, when inventory has declined in cost, or if inventory has gone obsolete. Along with the lower of cost or market method being required by GAAP reporting, other inventory costing methods allowed by GAAP are first in, first out, FIFO, method, weighted average method, retail method, and last in, first out, LIFO, method. Here are 4 key takeaways. 1. The lower of cost or market, LCM, method relies on the fact that when investors value a company's inventory, those assets shall be recorded on the balance sheet at either the market value or the historical cost. 2. Historical cost refers to the cost of inventory at the time it was originally purchased. 3. The LCM method takes into account that the value of a good can fluctuate. Under this scenario, if the price at which the inventory may be sold dips below the net realizable value, NRV, of the item, which consequently results in a loss, then the LCM method can be employed to record the loss. 4. The LCM method is a tenet of generally accepted accounting principles, GAAP. Hope this would help. Thanks for watching.